Thank you so much for coming. It's a pleasure to have Juliana Salomão from Minnesota University with us. She's going to present Granular Investors and International Bond Prices, Scarcity-Induced Safety. Thank you so much, Juliana, for accepting our invitation. Please, the stage is yours.
So thank you so much. I'm going to do the presentation in English because I can't. Edmar Basha used to say that Portuguese is the language of the heart and English is the language of the mind. So, you know, it has my heart, but my mind is just used to doing it in English. So, so this is joint work with Esther Faya and Alexa Ventula Vegassi. Alexa is, we're using confidential data from the European Central Bank because Alexa is an employee of the European Central Bank. The usual disclaimer that these are just our views and not views of the bank apply. So let me tell you a little bit. Okay. Let me tell you a little bit. So the rise of capital flows in the last decade has been mostly intermediated by institutional investors. We're going to say that these institutional investors are large, and therefore there's the granular word coming from it. That's these institutional investors are granular. In this paper, we're going to study the institutional investors' demand for corporate bonds, specifically for their currency denomination and firm's country of issuance. The preferences that these investors have in respect to these characteristics, we're going to show that it leads to an impact on bond prices, and these impact on bond prices imply differential safety of different bonds. We're going to study the period where the ECB is shocking the demand of bonds, of a specific type of bond, and with its asset purchase program. And we're going to show how this impact affects the pricing of these differential investors. While the literature has documented some holding patterns for institutional investors, like mutual funds work of the capital allocation folks of Majority et al., and the work of Elene Ray on equity, due to lack of data, we still don't know if the different types of institutional investors behave differently and the impact on prices. So in this paper, we're gonna answer this question using data for all Euro area investors. So we observe all the holdings security level, and I'm going to be very specific about our data of Euro area investors. And we're going to be able to document some patterns and see some pricing impacts. So we're going to leverage on these unique confidential data set of the universe of securities held by Euro area investors, and they're going to be able to be issued either by domestic or foreign bonds. And we're going to match with prices of these bonds. So we're going to use non-financial corporate bonds and a number of bond characteristics. The name of the data set is SHSS, Security Holdings Statistics. We're going to focus on non-financial corporate bonds denominated in euros and dollars, as any other currency is less than 5% of our portfolio holdings. Our bonds can be issued by Euro area firms or abroad. We observe this. And we're going to study the impact on currency prices. We're going to merge the security level holdings with bond price data and other bond characteristics. We're going to use this information in our econometric specification to calculate the euro-dollar yield differential that ends up comparing the same bond issued in different currencies. So if you want to think about this, what we're going to do is going to compare UIP and CIP deviations inside the portfolio holdings of these investors. And we're going to be leveraging on a period where the stock of euro-denominated bonds is being shocked by ECB asset purchase. So ECB, we're going to study between 2013 and 2021. And during this period, as I'm going to show, ECB is demanding, it's buying a set of both government and corporate bonds, but they have to be denominated in euros. And this is going to affect the supply, create a scarcity on euro area bonds that are going to be preferred by a certain type of investor. And this is going to generate the pricing patterns that I'm going to show. So this excess demand is going to allow us to evaluate the role of investor demand. So we're shocking, in a way, the supply to see kind of the elasticity of the investor demand. So let me give you a summary of exactly of what we find. So what we find, we're going to do two types. The presentation is structured in two parts. First, I'm going to show you a bunch of holding patterns for the different types of institutional investors. I'm going to show you how much they hold in euros, how much they hold in dollars, and some patterns in terms of home currency bias and home issuance bias for different types of investors. I'm going to show you that investors are heterogeneous, and then I'm going to go in and show that that this heterogeneity impacts on pricing of the euro versus the dollar bond. So the first part, we're going to document these facts top down. So from aggregate data aggregated across all types of investors, up to then disaggregating across investor classes. So we show that in aggregate, so when we aggregate all types of euro area investors, these investors have home currency bias, as about 70% of their portfolio are denominated in euros, but they do not show any type of home country issuer bias. They hold about only 50% of their portfolio issued by firms. These are non-financial corporate bonds issued by firms that are with residence in the euro area. But we're going to show also that there's two categories of investors that are very large. These are our granular investors. And I'm going to define them in a minute, but for now I'm going to call them mutual funds plus and insurance companies and pension funds. Mutual funds plus, I'm going to give you the category in a minute, but it's kind of like the idea of like the Morningstar data that Matteo Maggiore has used with Brent Newman and Jesse Schreger. They account for about 57% of the portfolio holdings in the euro area. Insurance and pension funds account for about 30%. So these are our big granular investors that hold about 90% or intermediate about 90% of the investments or portfolio holdings of euro area investors. And then we show that these investors, specifically these two categories, are heterogeneous. They're not all the same. So if you only see mutual funds, you cannot assume that insurance companies and pension funds look the same. You cannot generalize one type of result. I'm going to show you that mutual funds plus has no currency or country bias. They hold euros and dollars about the same, and don't have a strong preference for euro securities issued by euro area firms. On the other hand, insurance companies and pension funds have a strong home currency and home country bias. They really want to hold the majority of their portfolio, over 90%, in euro-denominated securities, and they have not as a strong preference for euro currency as they have for euro-denominated firms, but they still prefer firms from the euro area. And we're going to show.
When you are saying country bias, you are considering Europe a country, or you are, because currency, there is a difference between currency and countries in Europe.
So I'm not splitting it by countries. I'm splitting it like euro area country. So I'm going to split the countries across three categories: euro area, US, and rest of the world.
But it could also, there would be an interesting question to see if there is home bias among European countries. You could divide it two types. Maybe it will be less intense, but there will be some home bias inside the euro area.
We could. So actually, the way that the data is structured is that we actually do observe the country of issuance and the country of the investors. So in what I'm going to show you, we aggregate all euro area the same, but we could do it per country. The issue is that ECB does not like us to present data that separates countries, because that can have, a saying like it shows too much of the data. So when we tried to do a little bit more disaggregated this way, they didn't let us. So by the way, like anything I'm showing you here has been vetted in multiple levels at the ECB before I can show you to anyone. So they don't like when we work because it can generate political issues inside the ECB if you start disaggregating it per country. Saying like, oh, if
you may disaggregate per countries, calculate and take the average of the home bias among countries.
You're
and
right.
Don't show anything specific to a country.
Yes, that would be great. Yes, I think by that we can do it. As also, I'm going to show you also a lot of volumes, and I could do it also only shares, which we used to have some results with that on shares. But yeah, this is a good point. I'll talk to Alexa about looking at this way. Perhaps like you become many figures.
And Juliana, is just to be clear, this is only institutional investor money, or you also have individuals? Is everything?
We have the universe. So
Universe,
everything
perfect.
that
Okay.
is held in the euro area, we observe. However, households, so direct holdings are very small.
Okay.
And I'm going to show you in a second. So I'll
Okay,
be very
perfect.
precise. But yeah, no, we see it all. It's if it's held, we see. Because this comes from you have to report. So it's not assumed shares. This is like tax type of reporting. So finally, in the paper, we showed that the pricing of the risk across investors can explain what we observe using time-varying loss aversion. Okay, so let me give you a little bit of help placing our findings in the literature, and I will be here quick. So we relate to this long literature of studying familiarity bias. So there are papers by Elaine and the majority and Matteo Maggiori. I think what we bring to this literature is that we study the impact on prices. It's really rare that you observe portfolio shares. Usually these shares are implied. You observe portfolio shares across all investors and that you observe prices, and we do. So this is, a very unique type of reporting. We're also going to connect to the UIP, CIP literature, uncover different parity deviations and cover different parity deviations. But what we're going to show that it's very different is that we're going to use granular level data to calculate these deviations. So we're going to be able to do this besides using granular level data, like security level data. We're also going to do it within the investor portfolio because we know what the investor holds. And the only other paper that has used our data has been Kojin and Yogo's paper. But what we do is that we add the impact on currency prices that he hasn't really observed. And we also relate to the literature on scarcity and generating safety that has been established in the theoretical work of Caballero, Gorinchaz, and Pari. So let me tell you a little bit how the paper is structured. I'm going to come in, describe the data a little bit more, some stylized facts, then I'm going to measure the euro-dollar deviation, and then show you that this is coming, the shape that we observe is coming from the ECB shocking the asset purchase, and then I'll have one slide on optimal portfolio model. So let me start by describing the fantastic data we use. So the data we have is SHS, Security Holding Statistics. It has all equity and debt holdings by all euro area investors. It's collected by the European Central Bank. It started being collected in Q3 2013 to Q1 2021. Just to give you a sense of the magnitude of the data set, in June 2014, the total holdings of equity and debt has been about 18 trillion euros. We have aggregate information on the holders of each security, so we know which type of holder it is. And we have security level information because each security that it's in our data set has this ISIN, which is the security international identifier, that allows us to connect the security with currency that it's issued on, price, issuer country, maturity, every type of security characteristics we have. And we're going to focus on non-financial corporate debt in euros and US dollars. The US dollar and euro is about 95% of this holdings, about 1 trillion, 95% of the non-financial corporate debt. So any other currency besides euro and dollar only accounts for about 5%. We're going to do euro and dollar because we want to see the UIP and the CIP across these two and the preference across these two, which are the main currency that is being held. Let me tell you how we're going to structure the cutoffs of the data. We're going to go top down. The way that we observe investors, there's 23 investor categories. We're going to group them into these 6, just so that the pictures look palatable. We have monetary financial institutions, so deposit-taking institutions, ICPF, which we aggregate all insurance companies and pension funds, OFI, which is other financial institutions. These are investment funds, mutual funds, and other financial corporations. So this is what I was calling mutual funds plus. Households, government, and non-financial corporations. As I'm already previewing, OFI and ICPF are the largest holders. We also, as I was telling Bonomo, have residency based of the issuer, and we separate them across euro area, US, and rest of the world. We could do more breakdown more finely, but we, again, it's going to be a lot of pictures, and I want to make sure that you see it. So here we see the first figure. As I was telling Rui, we do observe households, but they're very small share. So this is the orange right here. They're very small share. The largest share of holders is going to be ICPF, which is insurance companies and pension funds. This is the yellow, and OFI, the blue. They hold about 90% of the total shares. Also, here's the second fact that I was kind of alluding to. There has been an increase in this holdings. It was about $1 trillion in 2013, 1 trillion euros in 2013, sorry. And then it's about 2 trillion euros. So there was an increase in the holdings in these 7-year span. And it's mostly being not through direct holdings, but intermediated by these large granular investors, which is ICPF and OFI. So now I'm going to show you the currency breakdown of these holdings. So it's going to be a number of pictures,
Juliana,
all of them. Yes.
You said that the European Central Bank had a purchasing program in action. So by how much the European Central Bank position increased during this period, if that's relevant?
They're not going to be in the blue or the yellow, because these are going to be, I don't think they are exactly in this picture. It was a significant share, although the corporate purchases were not so large in comparison with the other part. I'll describe the program on the top of my head. I think it was about 2 trillion, but I'm not sure. But this was both government and corporate. And what I'm showing you here is just non-financial corporate bonds.
Okay.
But the way that I'm going to position the channel is going to be this idea that, you know, by draining a supply of one type of asset, you're going to start holding something similar or a substitute, and that's going to impact prices, right? So even if they are not buying just corporate bonds, they're buying something like they're buying, you know, treasury bonds or government bonds in euros, you're going to get something similar that it's going to have a spillover in the prices of the other bonds as well. So now I'm going to show you the currency. Yeah. So now I'm going to show you this same figure. So this is non-financial corporate holdings in the euro area. These are only bonds. And I'm going to show you the breakdown between euros and dollars. So here we see in blue is going to be euros. Every time in the top graph, you see volume, and in the bottom graph, you see shares. And here we see euros in blue and dollars in red. So again, it's going to add to 100 because anything that we are plotting, we purged out, we removed from our data anything that was not dollars or euros, which was about 5%. And here we see that euros is the dominant currency. Over 70% of the corporate bond holdings were being denominated in euros. In the paper, we show you the breakdown across every type of investor. Now, just for not to inundate you with so many pictures, I'm going to only show the 2 largest investors, which is OFI, other financial institutions. You can think about them as mutual funds, and insurance companies and pension funds. And I'm going to show you the breakdown across the currencies of these 2 investors. So here we see that while OFI, they like dollars, they hold about 45% of their portfolio in dollars. So they have a balanced portfolio between euros and dollars. Actually, insurance companies and pension funds, and this could be their mandate or their regulation, holds about 93% of euros. I'm not gonna say whether it's mandates or regulation, because what I want to show you is that this fact that they hold and have to hold in euros or prefer to hold in euros have an impact on prices. So what we see is that in terms of currency bias, insurance companies and pension funds hold about the majority of their assets in their home currency, while mutual funds are, you know, maybe more risk-taking or less regulated, that they hold a lot of dollars as well. So they hold 45% of this in dollars. But one important figure that comes out of this is that if you only have data on mutual funds, or if you only thinking the world looks like mutual funds, you're gonna not truly perceive the currency composition of all types of investors, because they are heterogeneous. And this is one of the messages that we wanna pass. So now we're gonna start looking at the currency of the residency of the issuer. So we're gonna have, again, it's the same block of data, but we're gonna cut them across the residency of the issuer. So we're gonna have US issuer in red, euro area issuer in blue, and rest of the world in yellow. So what we see here is that while about 70% is in euro denominated, we actually see that they don't have as strong of in aggregate, so top down, their desire for euros is actually stronger than their desire, their preference for euro area issuer, right? Because they hold 53% only of the euro area issuer, meaning that a lot of the bonds in dollars and in the rest of the world are actually being euro denominated. So you can think about this as, and I'm going to show you in a bit, while actually the share of euro denominated issuance from US and rest of the world investors actually increasing. It's going to be because it's going to be cheaper to issue in euros than to issue in dollars, from the perspective of paying a lower yield, and exactly tying this down from the holdings of the investors. But on the other side, we kind of break this down. So on the side here, we break the country of issuance denominated across the different types of institutional investors. So on the top, you see OFI. You see that their home, they're more willing, they hold a larger share of their portfolio issued by non-euro area firms. So they hold only 40% of their portfolio by euro area firms. And then ICPF, and then it starts increasing. The home issuer bias actually is more prominent in ICPF, and then monetary financial institutions even more, and households hold 80% of their portfolio actually by firms in the euro area. But the other thing that you can also see from here is that the home issuer bias has been declining over time, where even for households, if you look in the beginning of our sample, they held very little from abroad. They're starting to hold more and more. One of the reasons could be that these rest of the world and US firms are starting to issue in euros as well more, which is something that I'm going to show. Is there a question? No. Okay. So now I'm going to cut by both country of issuance and currency. And I'm just going to focus on US and rest of the world firms, as euro area firms are just almost 100% in euros. So it doesn't make sense to break it down by also issuer and country. So here we have US issuer in one side and rest of the world issuer in the other side. And we have here holdings in euros and holdings in US dollars. I did the axis so that you can compare across them. And what you see here is that while for US issuer, so these are US firms, bonds being held in the euro area in different currencies by different types of investors. And you see that while OFI, so mutual funds, they have a strong preference to hold US firms in dollars, you see here that insurance companies and pension funds hold in euros. They have a strong preference to hold this in euros. So for these ICPF, you see that there's a strong and growing issuance of US firms in foreign currency. And what we're going to discuss is that they're trying to cater to these investors, these insurance companies and pension funds that want to hold bonds. They don't have a strong preference for euro area firms, but they have a strong preference for euro denominated bonds, which then applies in the pricing. So we see that specifically, this is the same also for rest of the world, where you see that, blue, which is OFI, hold both, a lot of them in US dollars and in euros, but most of it, the majority of it is in majority of the dollar bonds issued by rest of the world are held by mutual funds, where for the rest of the world, they're just held by insurance companies and pension funds, the yellow, in euros. So let me just summarize before I start looking at the impact on prices. So we showed that OFI, mutual funds, and insurance companies and pension funds are granular investors with heterogeneous preferences. So granular meaning they're large investors that have heterogeneous preferences. We showed that OFI, they like dollars and foreign firms, possibly because, as I'm going to show you, these dollars and foreign firms are giving a higher return. And ICPF, they like euros and euro area firms, although their preference for euros is much stronger than their preference for euro area firms. They don't mind holding foreign firms if it's issued in euros. And next, I'm going to see if this preference that we report by looking at the portfolio, so it's kind of a revealed preference, has an impact on pricing. And we're going to do that by estimating euro-dollar yield differentials, controlling for firm and bond characteristics. One thing that is important to note is that our investors are under the same monetary policy. And during the period, as I was telling Ricardo, ECB is purchasing assets that are only in euros, euro-denominated assets. So they're basically shocking the stock of euro assets that are very much preferred by ICPF investors. We're going to take the price impact not only on the price, but also on rebalancing. Because we have portfolio shares, we're able to actually see the impact that it has on the rebalancing of these investors.
Excuse me.
Yes.
Yeah, and Juliana, I was just wondering if this preference for euro-denominated bonds for the pension funds and insurance companies might be driven by just the problem of currency mismatch in their balance sheet. And I think maybe you should emphasize this more.
It could. So I was saying this a little bit for us. So I think it's a little bit beyond that. So we looked a little bit across the regulation. And what we see is that the regulation is about, it has to be about 70%. So not necessarily like the 93 that we observe. Obviously there could be, since we don't look, we don't have individual investment insurance companies data. We don't know if this is, some of them are at the regulatory level, others are not. But even that, it doesn't matter for us if we want to know the return differential, like if we want to see the price impact, whether you are only demanding euro-denominated assets because this is your bank's regulation, or whether it is because you prefer and you're representing your clientele, it doesn't really matter because it's going to have an impact on prices, right? Which is—
And just a quick comment on that.
Yes.
Like, even if you actually, like, your liability is most likely in euros if you are euro based, but you can do currency hedging. So you don't need to hold the bonds in euros. Yeah, so you can do the hedging separately.
Right. So I'm going to show that even,
yeah.
yeah. So you who is completely right. You could hold some forwards or these are going to be much longer term bonds. So they could even do currency swaps. And I'm going to show you that there's going to be CIP deviations inside the portfolio. So even once they hedge it, actually there is a lower return of holding it in euros. But so this is exactly where I'm going to get in a minute. There's going to be pricing deviations. So we're going to start measuring this euro US dollar return. Let me be very precise on how I'm going to do it. So remember that our data is security level. So if you had 2 time series, one in dollars and one in euros of government bonds, right? You have a yield, you have a, kind of a 1 year bonds in euros, 1 year bonds in dollars. You could just compare them and calculate like UIP or CIP deviations. But the type of data we have is granular data, right? So we have bond level data. And beyond the fact that we have different currencies, we also have bond level characteristics that we need to purge from our data so that we have this UIP CIP deviation in that kind of resembles the strategy of having just comparing the 2 series. So the strategy I'm going to describe here, this regression strategy, is just because of the nature of data we have, which is not macro level data, but security level data, that is going to allow us to not only to control for bond characteristics, and that is really good because it allows you to control for selection of, you could say that this yield is lower in dollars or higher in dollar just because of some characteristics of the bond. Because we're going to control for bond characteristics, this is now what we're capturing, right? We're purging for all these type of characteristics that could generate selection. So in truly, we're comparing the same bond in different currencies. So we're going to do that by estimating the following regression. YIT is the yield on the secondary market at time T of it's bond specific. I is going to be a dummy, the one here, whether the bond is denominated in euros, and it's going to capture the currency yield differential. It's going to be estimated at every quarter So you can think about this as running like this regression every quarter to capture the time varying nature of this differential. As I'm going to describe next, we're going to compare euro and dollar rates without adjusting for the forex, but we also going to do the adjustment. So we're just going to compare like raw dollar and euro rates. Obviously, this could be from foreign exchange. So we're going to adjust for foreign exchange in two ways. We're going to adjust using survey data of expected exchange rate movements, but we're also going to adjust using hedging, using derivative data. So we're going to use swaps to make this adjustment. We're going to control for firms and bond characteristics so that in the end, it's like comparing for the same bond issued by the same firm in two different currencies. To disentangle the channels that I'm going to describe, we're going to estimate subsamples by using these dummies. So it's kind of like, instead of just cutting the data and estimating the same regression inside, it's the same in principle of just doing these dummies. So we're going to have the dummies here on type that is going to be either ICPF or OFI, where we're going to do it inside the portfolio. And we can also, these dummies can also be either US issuer or rest of the world issuer. So if we're doing just the regression in the entire sample, all we care about is and I'm going to show you the results in plots, is going to be this dummy here. If we're doing it using subsamples such as only ICPF investors or only OFI investors or US or only Europe, we're going to do the alpha 1 plus alpha 3. So we're going to add the 2 because we want to capture the interest rate. Okay.
Juliana, could you please clarify how you're going to run this regression? Because there are things in like parameters, what I would call parameters at least, that vary through time.
So the type also varies through time.
Yeah.
So there's a typo here. So the type also varies through time because basically the way we're running it is going to be the bond only shows up. So suppose we do the subsamples, right? The dummy only shows up if that bond is held by that investor, or the dummy only shows up if that bond is issued by a firm in the US.
My question is a little bit more basic. So T here runs in which frequency? Because you said something about quarterly. So and you're going to estimate for each quarter this regression.
Yes, without the T, sure. It's going to be identical because what happens is that whether the bond is held by so the bond only shows up in my sample if the bond is held by a Euro area investor. So it's not like I'm doing it across all the bonds that exist, but I'm doing it across the bonds that are inside my sample, which is when they're held by a Euro area investor. We're going to do secondary market pricing. So the yield is also varying every quarter.
And Juliana, just another related question, actually. So you have the holdings is quarterly data.
Mm-hmm.
Yields, you have more frequent data. Yeah. Because I'm trying to remember, like, I don't remember everything by heart, but like the Veldehan paper, like the deviations in cover interest parity, I guess they show that there was like intra-quarter kind of moving deviations. Yes.
Yes.
It was like
yes.
Like it was higher and lower depending if you're closer to the end or beginning of the quarter.
Yes.
So
I know
you're
exactly.
not going to be able to observe that. Yeah, here. Yeah. But you could if you use more frequent pricing data.
Yeah. So we could have more frequent pricing data because we know the bond, so we could do that. So Adrian's paper with Wenchen, they are trying to say that the UIP, the CIP deviation it's coming from regulation of how the banks look. And it's not something we're trying to do because for us, actually, it's not going to peak at certain times, but as you're going to see, they're present, throughout the period. So it's a little bit of a different focus. We could, if we assumed that the bond is being held for the entire quarter, we could do that too, although I'm not sure how the results will look. I mean, I can think about it a little bit. Okay. So let me tell you a little bit of our specifications. So I'm going to show you this regression. So here's going to be the yields, right? So this is the yield, whether this is a dollar bond or an euro bond. Obviously, if we don't do anything, if we just leave the yield like that, whatever this dummy is capturing is going to be, dollar minus euros bonds, which could be capturing some expected exchange rate movements or hedged exchange rate movements. So what we're going to do is that we're going to do that way, but we're also going to create a synthetic bond yield so that we can compare apple to apples. So if the bond is in euros, it's just going to be the yield itself. If the bond is in dollars, we're going to transform them into euro bonds by using the expected exchange rate movement. So this is going to be kind of a parallel to the UIP deviation. So we're going to use the survey for that with the same maturity of the bond. We're going to use residual maturity if the yield is in dollars and it's unhedged. So this is going to be kind of a parallel to the UIP. We're going to use consensus forecast at the same time of maturity. If it's $1 and we want to do a CIP violation, so we want to do the hedged, we're going to use exactly the strategy of Wenxin, Du, Tapper, and Verdejan, that, you know, instead of adjusting by, we could just adjust by a forward rate here to do it. But the problem is my bonds have an average maturity of 6 years. With an average maturity of 6 years, the forwards are not very liquid. So what Wenxin, Du, and Adrian Verdejan do is that they use currency swaps, cross-currency basis swaps to actually hedge this risk. So we're going to do exactly the same. I actually have lengthy meetings with Wenxin so that I was doing this properly. And we're going to adjust the exchange, the dollar yield by using a cross-currency basis swap. So we're creating the synthetic. And so whenever we're using in that regression, we're calculating the raw yields. Whenever we're using this, when the bond is in dollars, we're calculating UIP deviations. And whenever we do the bottom one, we're creating CIP deviations. The last thing to say is that we're going to run these regressions both unweighted, meaning every bond has the same weight, or weighted by weighting by the portfolio weights of each investor or of all investors inside the bond. This is going to allow us to capture also rebalance across investors. So we're going to use curculus where we're going to lag the weight so that we don't have any endogeneity issues. So this is the first, in the next couple regression slides, I'm going to always show this figure. So what is this figure? It's going to be this alpha, this dummy variable that is capturing the interest rate differential. And I'm going to show you this, both the raw, whenever I just use, if it's dollars, is the yield itself. If it's euros, is the yield itself. This is the UIP deviation, the unhedged, where we adjust by the expected exchange rate movements. And the last one is the hedged, the CIP deviation. And here, what we observe is the following, that the standard deviations are going to be the dotted lines around it, which I'm sure you cannot see given that this is in a screen. And then black is going to be the unweighted, and the red dashed is the weighted by portfolio shares. And first we see that, you know, just comparing raw yield, the euro yield is lower than the dollar yield, about 150 to 200 basis points. And what you also see is that it's declining in our sample. I'm going to make sense of this in a bit when I'm going to discuss ECB purchases. Next, we see that, you know, this is going to be down hedge. We do see UIP deviations happening throughout the period, and even CIP deviations. It's really hard to see here, but, you know, the dash, the dot line here is the 0. It's about, you know, for periods, it reaches 50 basis points. When I concentrate in certain bonds, it's going to be even larger. So what we see is that throughout this period, for the corporate bonds held in Europe, we see that it was lower yield to hold. There was a lower return coming from holding a euro-denominated bond. So this is going to be, I'm going to now break this down across the different issuers. So here is going to be each holder, each issuer group. And we see that actually, I mean, there's not a lot, but the the bonds issued by euro area investors is actually lower throughout the sample. So this is going to be the blue. But it happens through all, you know, it happens through all bonds, US bonds, which actually before ECB starts purchasing, it was inverted. So it was cheaper. The CIP deviation was more in line of what Tepper and Verdejan saw, where, you know, you would have this premium for holding, lower return for holding a dollar bond. But, you know, even the CIP deviation, what we see here is that the CIP deviation is even larger and about 50 basis points for a lot of the sample when we are considering, and this is unweighted and this is weighted, when we're considering euro area firms, euro area issuers. So now, yes?
Can I ask you a question, please?
Sure.
So you're calling it CIP deviations and UIP deviations.
Yes.
But on the left-hand side, you have the yield on a corporate bond, right?
In both sides.
Regression.
So this is always a corporate bond, but it's basically a UIP or CIP deviation in the corporate bond market. Because both sides are corporate bonds.
Right. So you're not looking on the right-hand side or anywhere, there is no public bond return.
So I'm not thinking about the premium between corporate and sovereign or corporate and government. I'm thinking just like if I compare two corporate bonds and I'm purging for everything else. So like the only difference across the two corporate bonds is the currency that it's issued. Which one has a different, what is the difference in return across them? So that is the idea of the exercise.
Okay, now I was just thinking because there is this sort of literature, it's a bit small, but on the equity, sort of uncovered equity parity, right? Which is yield on equity that you can actually, you know, it's corporate, but it's kind of basically returns on assets that are sold in stock exchange. And actually what you're looking there is something different, right?
Yeah, so this is like a corporate bond yield differential.
Yeah.
Currency yield differential.
All right, okay.
Which, you know, I don't think it's also not a large literature because a lot of the times we don't, you know, we don't have a lot of bond holdings.
Yeah, which I mean, it makes me wonder, why don't you kind of use on the left-hand side a sort of excess return? And then you could.
I could.
Yeah.
I mean, which then if I use an excess return,
it would be a different question, but anyway, I mean, I was just wondering the.
Yes. So I mean, I could. I didn't do it because I don't want to think about the fact that, like, if I use excess return in my head, at least maybe I'm not understanding you exactly. It would be the, you know, what is the UIP in the corporate bonds versus a baseline UIP in sovereign bonds or CIP in each of these bonds, right? Because what I want to say is something about the fact of, you know, drag on like like if you change scarcity, the currency is different. I'm not comparing even in my, you know, first part of the analysis of the portfolios, I'm not really thinking about sovereign bonds. I could, but yeah, I'm not. I'm just focusing on this class of assets. Okay, so let me talk a little bit about per investor. So I do the same where I do per investor. On the top, we have US. This is US, and then you have in black, you have OFI, and in red, you have ICPF. Here is weighted, unweighted, both is raw, unhedged, and hedged. And here we see even like stronger, I wanna point out, I don't know how much this is coming out in the screen, and I apologize for that, is the fact that, you know, even the ICPF, this is inside the insurance companies and pension funds portfolio. And you can see that they're, even after they adjust for, or after they hedge for exchange rate movements, they're holding a significant, and, you know, you guys, a lot of you I know are traders. I mean, a CIP deviation, which is a non-arbitrage condition of 50 basis points, is pretty significant. So here we see that the deviation in the US bonds held by insurance companies and pension funds is actually wider, meaning that even after they hedge for the risk, the bonds that insurance companies and pension funds are holding, they're getting a lower return or requiring a lower return to hold these bonds in euros. So what happens here is actually in line with the fact that I showed before, that you start seeing this, and this is also true here for the rest of the world, you start seeing these firms in the US and in the rest of the world catering to these investors that really prefer bonds denominated in euros. And then they're doing that because it requires them a lower financing cost. So finally, we're going to do it for, you know, longer maturity bonds above 6 years. So here we have both unweighted and weighted. This is the three figures. So this is the raw returns comparison. This is the UIP comparison, and this is the CIP comparison. So here we have in black all corporate bonds, and here in red we have long maturity bonds, bonds with maturity above 6 years. And here the figure becomes even more stark, which is that there's a very large CIP deviation in bonds with maturity above 6 years. UIP deviation, it's even larger, which what we're going to say is that this starts the fact that, you know, whenever the asset purchase programming are happening in the ECB, they're buying longer maturity bonds. So we're going to start talking about the two channels that we think really explain what we observe. And this is kind of one of the evidence that we have. So here I'm going to start talking a little bit about the ECB asset purchase that is shocking the supply or the leftover bonds that these investors can buy. So it started mid-2014 to support the monetary policy. The total purchase between 2015 and 2022 was 3 trillion euros, both government and corporate bonds. Only euro-denominated bonds by euro firms were participating in the corporate bonds. Government bonds were only in euros. So there's this drag on the supply or on the availability of euro-denominated bonds. We think that there's two channels that affect the pricing and the currency premium. And we believe although these channels exist when specifically talking about the yields itself, we think that we're the first ones to highlight this on the premium and the currency premium itself. So this first channel is the local supply channel by D'Amico and King, where the scarcity generated by asset purchases decreases the yield of the bonds not being purchased, but also substitutes. And then there's also this duration channel by Vianos and Villa and Kogan et al., which is that as there's this purchase of these bonds, it smashes the duration risk in the portfolio. And then especially because these are in the longer maturity bonds, which impacts more the longer maturity bonds, which explains why we see the CIP and UIP deviations and pricing differentials being larger on the maturities above 6 years. So here we plot, you know, it's kind of just the two figures. Here we have net purchases in billions of euros by the ECB, and then in black is going to be the stock. In black, sorry, in orange is the stock. And here we put the interest rate differential across the two. And what we see is that, you know, it almost, and I'm going to show you correlations in a minute, it almost looks like as the more it's getting purchased, the less is going to be the return. I'm sorry. Okay, I guess it wasn't me. The lower is the interest rate differential. And then whenever ECB stop purchasing, it flattens out and even starts rising. And then it drops again when the purchase happens again. So is this going to be the scarcity generated? It's actually even more impactful and easier, harder, quicker to respond in the long maturity bonds. So what we do next, so we're going to estimate the impact of the purchases on the residual adjusted by the expectation. So we're going to get those graphs that we have on the alpha that adjust for exchange rates. And we're going to run a correlation, if you want to say, between the purchases and our and the interest rate differential. So we're going to do this with the UIP residual to get the impact both on the interest rates, but also on the exchange rate movements. And we're going to regress it on the lagged stock purchases. And what we see is that
Juliana,
yes.
You're going to do the same thing for CIP or
yes,
just
I can
UIP?
do it for any.
Yeah, both. Because I guess like you mentioned that like you're looking at long-term bonds and the UIP here is also going to be difficult to measure this because of the expectations and you
Fair
don't
enough.
have long-term
I do have long-term
forecasts.
expectations. I do have long-term forecasts in the, it does go 6 years plus the forecast we have from the ECB, but you're right that they are not as precise. But I mean, so would be the swaps because we'd never know what's going to happen in the future. But we could do it also the CIP as well. And we do see that there's this negative correlation. So the forecast data we use is coming from the ECB. So I don't know if they have special stuff. But we have the survey data, sorry. We do see that there's this negative correlation. So this is just kind of a visual of what I showed between the UIP residual, the alpha of the UIP regression, and the total stock. And it's pretty significant, both total stock and lagged, meaning that, you know, it is reasonable, especially when we go into long maturity bonds, that this drag that the ECB is generating on the total stock of bonds is generating these price differentials that we observe. And this would only happen if we would have that institutional investors observe dollar bonds as not being substitutable for euro bonds, right? If these bonds are not substitutable, which is mostly the case of ICPF investors that have these strong preferences. If they didn't have such a strong preference, we shouldn't see this big impact on prices. They would just go and buy dollar bonds. So, and then we do a portfolio optimization across two large institutional investors. We showed that, different risk aversions across the two is going to generate what we see in the UIP and CIP. We're still working on making this more fun and, tractable. But we have this idea that the reason for the ICPF could be just having this strong preference for euros is coming from a differential loss or risk aversion than the other types of investors. So in the end, what I talked today is that institutional investors in the euro area are granular, but they're not all the same. Euro is the dominant currency and is preferred by some institutional investors, and this heterogeneity matters for price. Euro is going to have a lower yield than dollar, which actually this result is novel because there is always this perception of the dollar being the dominant currency and the dollar being the safety currency that has a lower yield than the euros, and this is not the case. Actually, this is just data coming from the portfolio holdings, and we think that the scarcity of the specific security programs of the asset purchase is generating this erosion of the dollar convenience yield and a rise of the euro safety, at least for non-financial corporate bonds held in the euro area.
Thank you, Juliana. Very convincing. Do you have questions?
I have one. So, Juliana, these asset purchases they're equivalent to a non-sterilized intervention, right? So they're going to impact the interest rate of a public bond.
Sure.
So the basic interest rate.
I guess that's the goal, right?
Yeah. But then there's an effect on the corporate bond as well. So yes. Shouldn't you control for that, or what am I missing here?
Why shouldn't we capture it? Because I mean, you're saying that there's the risk-free rate in euros is also dropping, and we should control for that. Is that the answer? Is that the question?
Well, yeah,
but
exactly.
You are because you're considering the hedging cost implicitly in some sense. Yes.
Yes, I mean, we could control more. I mean, Gordon Liao has his job market paper that actually does it in that way. And you're right, we could control more. We could also plot what is happening for the risk-free UIP across this to show that maybe they're not just the same type of result. But yeah, no, this is something to think about. That's a good question. Thank you.
Any other? Bom, obrigado, Juliana.
Prazer meu.
E esperamos vê-la presencialmente, então, no próximo ano.
Eu prometo que eu vou. Eu tô sofrendo porque, enfim, a vida tá bem complicada com muitas viagens.